Good evening, guys. Welcome to today's class. So today we are going to be talking about forex trading terminology. You understand? There's complete definition and examples and guide. You understand? Always remember, forex is a risky game. So trade only with what you can afford to lose. Always remember this. Trade only with what you can afford to lose. All right, guys. So last time we talked about currency pairs. You understand? So today we are going to be talking about current. We are going to be talking about bid, price, ask price, spread, pip, and others. You understand? So you're welcome. Please kindly indicate if you can see my screen very well. Kindly indicate. All right. So forex trading terminology, complete definition, examples, and guide. You understand? So these are things you should know as a forex trader. These are things you should know as a forex trader. You know, being a forex trader does not mean you just have to log into the market and start trading. You need to know what you're doing. You need to know what you're competing about. You need to know the main terms of what you're doing. All right. So here comes bid price. You understand what is the bid price? Bid price is price at which buyers in the market are willing to purchase a base currency from you. In plain terms, you understand, it is the price you receive when you click sell. You understand? So just as I will try to explain this with the lowest language as I can so that we can understand it. So just as you know, if you want to buy, if there's an option of some product in the market or something, you understand, there must be um, a state out or a layout price. You understand that the market or the owner or agencies or the agent or whoever that is interested, that is involved or that is in charge of that particular product is willing to sell. You understand? So this is the price they are going to show you at point of sell. You understand? Or at point of buy. So this is what bid price is talking about. You understand? Let's say, for example, as you can see, Euro USD. The market quote for Euro USD is 1.08550. You understand? So 1.0852. If you open a set trade, you understand your entering price will be 1.0550. You understand? Example 2. As we know, us is gold. You understand? That is gold versus USD. Then gold is quoted at, this is not the actual price of gold at the moment. This is just an example. So it's quoted at 2350.10 and 2350.50. If you place a sell order, you are selling at 2350.10. You understand? So this is what bid price is trying to talk about. All right, let's proceed. Ask price definition. So the ask price at which sellers in the market are willing to sell a base currency. You understand? At which price sellers is willing to sell a base currency. You know, last time we talked about currency pair. We understand base currency and we understand quote currency. You understand? So that is it. So this is the price at which they are willing to pay to sell a base currency to you. You understand? In plain terms, it is the price you pay when you click buy. You understand? Remember, our bid price is the price you pay when you click sell. You understand? This is buy side now. You understand? So it is the price you pay when you click buy. You understand? Example, in the quote 1.0850 slash 1.052. You understand? If you open a buy trade, you understand your entering price will be 1.052. You understand? Example, gold again. You understand? That is AUD/USD. You get it? So in the quote 2350.10 slash 2350.50, if you place a buy order, you are buying at 2350.50. You understand? So this is what he's talking about. All right, let's proceed to the next. So spread, you understand? So the difference between the ask price and the bid price is equal to spread. You understand? Ask price, bid price, that is equal to spread. This spread represents the transaction cost or charge by the broker to execute your trade. You understand? So, when we talk about the big players in the market, who moves the market, something, you understand? You remember we talked about brokers at the last people, brokers via, we talk about individuals, retailers via brokers, you understand? And I also told us that brokers are intermediaries between you and the market, you understand? So just like Swift, just like a Swift network, you understand, or the channel, of course, Swift, the channel or wire transaction that you do, you understand? In any transaction that you process, there's people in charge handling the network in which your money passes through. You understand? So in this case now, brokers and forex trading handles this channel. You understand? Your profile is seated under brokers account or platform. You understand? So they charge you commission, as it as commission for every transaction you place. You understand? So now, when you want to place a trade order in the forex market, when you want to place an order in the forex market, you understand, either buy or sell, you will see a line. You understand? A line that will come from the bid price to your asking price. You understand? If you have a good broker, the line is actually little. If you have bad broker, it's actually wide. Then if you're trading on other if you're trading on, let's say, exotic currencies, the bid price is also wide. You understand? If you're trading on major currencies, the bid price is mostly slim. You understand? So when it is wide, the broker makes much money from you. When it is slim, they make little money from you. And the slimmer it is, the better for you as a trader. So now what this happens is, before you start making profit as a trader, you understand, this broker must have already covered his or her charges. You understand? Because the line will come from your bid price down to your asking price. So when the bid price line hits your asking price line, the broker have already covered his asking this in his the broker have already covered his spread costs and charges from you. Then once these charges is covered, then this is when you will start making profit or loss from the trade. So that is spread. You understand? Let me see. Let me show us example of spread. I think I have something open here. Okay. Okay, this my trade this trading um this trading account, you know, because of the time and the spread here is very, very little, you understand? Until I enter a trade here, this is when you will know exactly where the trade, where the spread will be like, and where it's going to stop. Because this is very, very, the trade here is very, very, the spread here is very, very close. You understand? But let's say, for example, if it is a wider, let me see if I will say a wide currency that has a bigger this thing spread, and use it for example. All this does not have. All this does not have. All this does not have. Let me check trade view if there's a spread in trade view. Because I want to open new one entirely. That's why it's showing me this. Because if I open my own setup, I may not be able to get the spread I need. These are indices. Let me check this US dollar. Even this, we cannot see spread here because of how it is. You understand? But just know, for other setup, you understand, just take this my ruler as an example. You understand? Your spread will look like this. Let's say this is the big price that is moving, the actual price that is moving. You understand? Your spread will be something like this white line of this nature. You understand? So the gap between this red tiny line and the white one, you understand, will be the spread of your transaction. So let's say, for example, if you sell this transaction now, if you click on sell now, you understand, the up red line you're seeing, you understand, we have to come and meet this my white ruler and start coming down before you start making profit. So the difference between this red and the white inside there is what spread is about. So that is commission paid or cost of each transaction you're going to take. So that is what he's talking about. All right. Right. So, for example, major pair, the GBP USD, you understand, has a bid of 126, you understand, and ask of 1206, 01202, you understand. The spread is 1.20, 1.2602, you understand, minus 1.2600. So your spread now is 0.0002, you understand, which is equal to 2 pip. You understand? So the same thing here, just as I told you guys, this is a cross pair. That's I think is under mini or is under mini. You understand? So the spread under mini is also more higher than in major currencies. They use these major currencies as first example. They are more slimmer, but in cross pairs, they are more harder. You understand? Don't worry, when we get to other practical aspects, you're going to see all this. All right. So guys, so PIP, what is PIP? You understand? When you hear about PIP, definition, PIP stands for the percentage in point or price interest point. You understand? Is the standardized unit of measurement for price movement in forex. You understand? For most standard pairs, 1 pip is measured at the fourth decimal place. You understand? That is 0.0001. For Japanese yen, 1 pip is measured at the second decimal place. That is 0.01. You understand? For example, 4 decimal pair, you understand? Euro USD. Euro USD moves from up to 1.0875. You understand? The price moved up by 25 pips. You understand? So to calculate this is okay, here's the calculation. Euro USD moves up from 1.075. You understand? So you move up to 75 pips, 25 pips. So this shows that probably the price was at 1.087, no, 1.0850. You understand? This shows that the price was at 1.0850. You understand? For example, 2 decimal point pair. You understand? This 1.0850 Euro USD. All right. So USD JPY dropped from 155.50 down to 155.10. So this means that the price moved down by 40 pips. You understand? So everything, just as I always say, after each class, try to go into the class again, read it and understand what we are talking about. You understand? And when we talk about percentage in points, you understand? This market moves every seconds as your heartbeat. This is how forex market moves. This is how pips moves. Once you click, or either you're there, you're not there, you understand? Every seconds, you understand this market is moving. That's percentage in points. Every movement, every single movement the market makes, either front or back, is regarded as the pips. You understand? So that is it. So lot size, you understand? Lot size, overview, and standard lot size. You understand? Lot size definition. So a lot size refers to the total volume or quantity of currency units being traded in a single contract. You understand? So in this aspect now, you understand, we have three major lot size. We have three types of lot size. You understand? The number one is standard lot size. You understand? So this standard lot size now, the unit is calculated by 100,000 units of the base currency. You understand? That is pip value, approximately 10 per pip on a standard USD dominated account. You understand? For example, buying one lot size of Euro USD means controlling 100,000 euro. You understand? A 10 pip move in your favor result in a plus $100 profit. You understand? So this means that every movement, every second this market moves, either back or front, if it moves in your favor, every second you are counting $10, you understand, per move. So imagine you taking a lot size that your account will either be getting profit $10 per seconds or getting deducted $10 per seconds. You understand? So this is why risk management is very important. So in lot size is one of the should I say the most, you understand, is the most regarded strategy or terminology. Let's say in risk management, when it comes to forex trading, you understand, is most regarded when it comes to forex trading. Because imagine you have, let's say, $100 account and you want to take standard lot size. You understand? It cannot even work. You understand? It cannot even work. But if at all it works, in fact, it cannot work. It cannot work. You understand? So even though you have $500 account, you want to take standard lot size. You understand? It will work, but imagine $10 per second. You understand? So I wonder where your stop loss is going to be for you to be able to move the market, for the market to be able to move in your favor and make you profit after the spread is being covered. That is after paying the commission. So this is what PIP lot size is all about. You understand? So example two, selling one lot size of GBP USD controls a 100,000, that is 20 pip move against your trade. You understand? So this is a 200 loss in your this thing. So when you sell with, depending the currency pair you're trading on, you understand? So lot size determines the amount of money you're going to lose in forex trade, and also determine the amount of money you're going to be getting in forex trading as your profit. You understand? So how you manage your lot size determine how long you're going to last in the market. You understand? So that is it. Now, another one is you remember we have three major type of lot size. You understand? We have three major type of lot size. You understand? Then the first one is standard lot size. The second one is mini or micro lot size. So mini or micro lot size, this unit, 10,000 units of the base currency. You understand? That is pip value approximately 1 per pip. You understand? So when the market moves either front or back, is either you are in profit in $1 per movement, or you are in loss in $1 per movement. You understand? So buying 0.10 lot size of odd USD controls 10,000 odd. A 30 pip gain earns you $30. You understand? That is $1 times 30. Example two, selling 10 lot of Euro USD controls 10,000 euros. A 15 pips loss result in a 15 downward. You understand? In your account. You understand? So this is what is trying to tell us, So I want to show us something. You understand? I want to show us something. What lot size is all about. Just look at the screen. Let me show us what lot size is all about. You understand? Let me show us what lot size is all about. So, but before I show us, we have mini lot size, we have standard lot size, we have mini lot size, and we have a micro lot size. Is the last one, but let me explain this micro lot size first. After this, I will now show us where your lot size is and how to input it on your forex trading platform. You understand? So micro lot size unit is 1,000 units of the base currency. Pip value approximately 10 cents. You understand, per pip. So this means that every trade you take, in every second, your trade moves either 10 cents forward or 10 cents backward. So when you take trade using micro lot size, you're either making 10 cents per movement, that is per pip. You understand? Or you're losing 10 cents per pip. This is what he's trying to tell us. So now, for example, buying 0.1 lot size of Euro USD controls 1,000 units. You understand? That is a 50 pip gain yields plus 5. You understand? Plus $5 You understand? I don't know if you guys are getting it. Kindly comment on the group chat. If you're getting what I'm saying, kindly comment. Because I told us that how you control your your lot size matters a lot. And your lot size is the key strategy that you need, you understand, to manage your risk in the forex market. You understand? You see, the standard lot size is moving 10%, $10 per pip. Your account, standard lot size move $10 per pip. Each time your heart beats, each time the pip, any movement on the market, your account is being on minus $10 or plus $10. The mini lot size is moving $1 per pip. You understand? So if you check, just imagine you're taking let's say for instance 5 minutes trade. We are going to get to those ones. And every second, you understand, your account is being deducted or added $10. You understand? So you check how much you're going to be losing in 5 minutes trade. If the trade is against you, then if you're in profit, you still check how much you're going to be getting in 5 minutes if you're in profit. So this is why lot size is very important in forex trading. Then let me show us what this thing is all about. But when you come to micro now, micro counts in 10 cents, which is very, very low. You understand? So your lot size, that means how much you're going to get and how much you're going to lose in the forex market. Let me show us what lot size looks like. So when it comes to your trading platform, you see something like this. When you click order, you understand? When you click on order, you know, then this is the volume. This is where you're going to enter your lot size. That's why they said lot size is always like this. You always see something like this. So this is standard lot size. From here down is always 2 decimal point. This is standard lot size. You understand? Then when you have something like this, when you have 0 here, okay, I'm coming. When you have 0 here and they come here, you say this. This one is mini lot size. This count $1 per movement. Where this count, where here count, where this count $10 per movement. You understand? Then micro lot size is this 0.1. This one counts 10 cents per movement. You understand? But still, mind you, this does not mean that you can still have 2 here. Instead of counting 10 cents, it's going to be counting 20 cents. You can have any number here, so can be counting. The same thing in your micro. If you have 2 here, instead of counting $1, it will be counting $2. You understand? So that is it. So you can still have 2 here. Instead of counting $10, it will be counting $20 per movement. You understand? But when you come to your risk management, you'll be able to master it and know how to apply each of them. Because I think I'm going to show you guys how to get your lot size so that you know how to manage your account. All right. I'm sure you guys must have understood what lot size is, the 3 type of lot size: standard, mini, and micro. Hope you guys understand it. Kindly indicate on the chat if you understand it before we proceed further. All right. All right. That is good. So now, before you proceed to trade, you understand, you must understand how to calculate your lot size. You understand? You must understand how to calculate your lot size. You understand? So we did little example here. I did a little example here. I did a little example here. You understand? So how to calculate your lot size is simply capital divided by 5,000. You understand? Just me, I'm telling you what I do myself. I'm not in calculating pips with anybody or all that. You can calculate pips, people calculate pips and all that. But when we get to support and resistance, you get to know more. People calculate pips, of which I've shown you. You understand? But what I need the most is my lot size. If I get my lot size, you understand, then I'm good to go in the market. You understand? Then your emotion determines how you manage your lot size. Your emotion, fear, greed, and all that determines how you manage your lot size. You understand? So now, for me, just for example, if you have capital, capital is the money you use to, the money you funded your account with. You understand? I'll show us an example here. If you have capital, lot size is capital divided by 5,000. 5,000 is constant. So your capital, any amount at all, can be 1,000, 2,500, or 200. You understand? But here we use 200 as an example. So lot size of 200 lot size is 200 divided by 5,000. You understand? So looking at it, this fall into our micro lot size level. You understand? It's not even up to, you see, your 200 is not even up to your, it's not even up to your mini lot size level. You understand? It falls into micro lot size level. So when you divide your capital 200 divided by 5,000, you have it. You have your this thing, your lot size. You understand? Then when you have 1,000, you say 1,000 divided by 5,000. You have, now you've moved to mini lot size. You have your mini lot size, this thing. That is, you're going to take your trade on mini lot size. That is 0.2. You understand? But there is one thing you guys should note, because I must tell you what I do by myself. You understand? When trading this, you have to understand its risk. You understand? So you have to, this is why you have to trade with what you're willing to lose, in the sense that having this block size alone is not enough. You understand? When you check your support and resistance, you check how much of, how many pips or how much movement, you understand, this 0.2 can cover you, considering how much you're willing to lose from this, your $1,000. This is what we determine if you're willing to take this lot size of this level. You understand? There are some people are in extremely risk management. This thing, their risk management is very, very much in order. You understand? So even though they have this 1,000 and they check the lot size, they calculate it and get 0.2. They will not still take the trade on 0.2. They will take it on 0.5 or 0.9. You understand? Some even take on 0.1. You understand? Because in some currencies that are very, very volatile, something like gold or BTC, you understand? 0.2 on a 1,000 account is very, very risky. You understand? Unless if you are willing to lose more. You understand? This is why it's very risky. And this is why you have to always take your trade with what you're willing to lose. You understand? So this is it. So this is how to calculate and get your lot size. And when getting your lot size, you still check if what your lot size is giving you, if the market goes bad, you understand, are you willing to lose what is giving you? This is what you have to check before you enter your lot size, even after calculating. All right. So leverage, a facility provided by brokers that allows traders to control significantly larger market position using a fraction of their own capital. You understand? So leverage, as you know, is just broker's way of boosting your trade. You understand? When we talk about lot size, when you have, why I said that if you have $100 in your account, you cannot be able to take a standard lot size. It's because of something like leverage and all that. You understand? So this means that if you have $1,000 in your account, you understand, that is 1 to 0 100. You understand? Then leverage allows you to control a position worth up to 100,000. You understand? That is one lot size. You understand? So in this case now, for you to take a trade of one lot size in your account, you need to have equivalent of the leverage required, 1,000, for you to take it. Then example, 1,500 leverage. With 200 in your account, then 1.5, 200 leverage allows you to control a position worth up to 100,000. You understand? So your leverage matters. Leverage is two-way things. You understand? When you leverage, your account allows you to take a certain higher position in the market. You understand? And in other side, you must not have below the amount required for you to trade, or the market will knock you out. You understand? So that is it. Then equity. Then when we talk about equity, the real-time valuation of your entire trading account, calculated as account balance plus or minus open position, profit or loss. You understand? So this, forget about the grammar. This equity is, for instance, you have balance of 200, 2,000. Your account is your balance. Then when you open a trade currently, and the trade is on 300 profit, you always see the profit. You understand? By the end of, at the tip of the trade, a moving trade, that's the real time live trade you're trading, you see it. You understand? When we start trading, I will show you all this again. You understand? So when your main balance is showing 2,000 and you're on profit, at the tip, you see the profit of 300. So this profit of 300 will be on the tip, adding to your account, and it will be showing, your equity will be showing 2,300. You understand? But this 2,300, the remaining 300 will not add to your balance, which is 2,000, until you end that position, until you end that trade. That is when the money will be added to your balance. It will move to the other end. You understand? Then, example, when you're losing trade too, your balance is 2,000. You understand? You have an open trade currently a minus 150 loss. You understand? Your equity is 1,850. Your equity will be on 1,850. You understand? So now, at the tip of your trade too, it will be showing 150 minus 150. Your account in balance area will still remain 2,000. But the second section where your minus 150 is will be showing 1,850. You understand? This 1,850, this 150 will not go out of this your 2,000 until you end the trade. That is when it's going to go off, and this one will change to 1,850. But in your equity area, it will be showing 1,850. You understand? So this is what equity is all about. So margin and type of margin. You understand? We have two main types of margin. That is, margin is required deposit collateralized by the broker to open and maintain open trade. You understand? Then we have initial margin. You understand? The mandatory upfront capital locked by the broker to exact moment you execute a trade. You understand? For example, if you open a trade in one lot size, and you're in leverage, just as we discussed about leverage, leverage requires 1,000 as initial margin. You understand? So this means if you want to enter a lot size and your leverage is 1 to 100, you understand, then you need 1,000 as a margin, you understand. So if you don't have 1,000 as your margin, as your initial capital, that will be locked to enable you enter this one lock size, you understand. You will not be able to enter the trade, you understand, unless you reduce your lock size to a smaller. You can go to mini, or you use micro lot size, so you can be able to trade, you understand, because it's not enough for you to trade. The maintenance margin, the minimum amount equity required to keep up position active. So this is if equity falls below this threshold, margin calls or stop out triggers, you understand. So this is trying to show us that if account requires 50% maintenance level, that's $500, and floating losses drag equity down to 5,490, the broker automatically close trade, you understand. So you automatically be closed because you don't have enough capital in your account to maintain the trade, you understand. So for every trade you take, you understand, you have to make sure that you put your stop loss and check your risk management very well, so you don't get stop out. And you should understand the maintenance level required for every trade you're taking, you understand. So example 2 analogy, having 5 liters, I use this as an example in one of my class. I think it's close to what we are talking about. This is just an example I created myself to show us what we are trying to talk about. So just as imagine having 5 liters of fuel in your car and attempting to drive from island to mainland, you understand. If fuel runs out midway, the car stops, trade gets liquidated, you understand. So this means that you cannot be aiming to go to mainland with 5 liters of fuel, you understand. You don't have what is required, so you just get stop out along the line, you understand. So for you to travel from island to mainland, you should know the required amount of fuel you need in your car for you to move, you understand. So that is what he's talking about. Then order and market order, that is market order. So what is order, you understand. So this is where other things is. Let me show us where you find your order. Just the same place I showed us about lot size. You understand what is an order? An order is an explicit instruction transmitted through your trading software, directing the broker to execute a transaction based on your analysis, clicking buy or sell. You understand? So when you open your trade and you want to execute a trade, either you click buy or sell. This, you're instructing the market or your broker to execute a particular trade after analyzing the market, you understand. So this is what order is. An order is executed instantly at the current best available market price, you understand. Example 1, market price for Euro USD is 1.0852. You click buy, market enter immediately, you understand, at 1.085. You understand, 852. You understand. Example 2, marketplace for gold is 2350. You click sell, market enter immediately at 2350. You understand. So this is an order, when you just immediately you click buy or sell, whatever the bid price is, it's going to execute immediately. So we have other type of order, you understand. We have types of order. That is pending orders. You understand? Buy limit. You understand? An order placed below current price, expecting price to drop into support and revise up. You understand? So buy limit order will show us. Let me show us buy limit order, what it is like. So this is where our order is, right? When you want to take a trade, this is where our order is, right? Then let me show us buy limit order. You understand? So now, okay, yes, I got a good example. Buy limit order in this trade. Okay, take for example, buy limit order. You see this market is at BTC USD is at 655. Is at 6555. Let's say it's at 6555. Then the this thing, the your buy limit order now. You know this market is still as buy area, but your buy limit order now, you can come and take it. Just watch my ruler. You can come and take it at this. You can come here and buy at 65,312. You understand? When you buy at 65,312, you are entering a buy limit order. You understand? So what you are predicting, or what your analysis is telling you, that when this market is going to drop from 65576 to this 65312. You understand? So once you place your trade here, when you enter order, you come here. Okay, because I'm not on a live this thing, I cannot be able to limit order. Okay, yeah, this is limit order. So this price now, you come to your price here, you select. If you come to your price here, you select this on your price here. You input all the numbers you saw at the tip, all the numbers you saw here. Yeah, this 65312 or whatever you saw here, you put them in your price section. You understand? So automatically, either you're here or you are not here, once this market drop to this place, you understand? If your analysis is correct, the market will take you in and sell off. And sell off. That is a buy limit order. Then we have another one. Sell limit, that's sell order. An order placed above current price, expecting market to rise to resistance and revise down. You understand? You should know that what we are doing here is buy. Either you are buying or you're selling. And most importantly, you buy when the market drops down and you sell when the market goes up. You understand? So what this one is trying to tell us now is that you see where the market is. If you want to buy, you allow it to drop here. If your analysis is correct, when it drop here, your buy should be here for a buy limit. Now, your sell limit, let me use another thing to show you us our sell limit. Let me look for a market that is already up. I didn't get market that is already up. Okay. It's not market that is already up. You understand? But let me use this as an example. I didn't get market that is already up. So, okay, let me use this. So sell limit now on this is Euro JPY. You understand? Let's say, for instance, this market wasn't here, this price wasn't here. You understand? Okay, let's say, for instance, it's here. You understand? It's here. And it's coming to as it is here now, it's coming to this place. You understand? You're selling it. Instead of selling here as it is, you place is at 186.236. You understand? Instead of selling here, you allow it, you place your sell limit at this place above the market price. You place it above the market price, 186. So you're thinking that, okay, this market is going to roll back to this place. Once you roll back to this place, it hits you and you enter. That is what sell limit is talking about. You understand? So that is it. So buy stop, you understand? The same thing here, buy stop, you understand? Another place above current price, expecting price to break through resistance and continue up with breakout, you understand? After you see all this, then set stop. I'm going to show us this together so we don't go back and forth to manage time. Our time is almost up. So now, set stop now, another place below current price, expecting price to break through support and continue to fall down. You understand? So I will show us this together. So buy stop now is this. If you have a trade of this nature, you understand? If you have a trade of this nature and you feel the market is going to get here and continue buying, you know it's above already. If you feel it's going to get at this 186 and continue buying, you place your order. When you open your order, you know our order. You look for buy stop, then you place your order here. When you place your order here, you leave it, place your stop loss and take profit. You understand? So this is the current market price. So once this market goes up and enters here, because you assume the market is going to break this resistance, once it enters here and break, it takes you in and continue buying up. That is what buy stop is. You continue buying up. Then sell stop, you understand, tells you that, okay, this market is going to come down. You see the current price that is going to come down to this place. And once it come down to this place, is at 186 now, and it tells you that it's going to come back to, it's going to come down to 185. You understand? And now it's a 185. Once you come to 185, it's going to break and continue selling down. So you're going to place a market here, sell. You're going to sell here, sell stop here. You understand? So that when you hit this your sell stop and continue coming down, it will take you and start making you profit down. So that is what buy stop and sell stop is talking about. You understand? So that is it. Let's look at our slide again. Please type on the chat if you're getting what we are talking about. Kindly indicate on the chat, on the group chat, please. All right. So this is where we come to the end of today's class. I'm supposed to use only 40 minutes on this class, but then we've already gone past that. So guys, thank you. Thank you for watching today's class. So see you guys again next week. Right? See you guys next week. All right now. Please don't forget, if you have any question, just indicate on the comment section. If you have any question, indicate on the comment section or drop on the group chat while we proceed. And I'm still going to upload this on the YouTube. I've not been able to go YouTube live, but I think one of these days, before we finish the class, we are going to go on YouTube live one of these days. All right, now see you guys.